All right, let's talk about one of the wildest patterns in all of finance, the speculative bubble. Today, we're going to break down how a flower from the 1600s and a digital currency from the 21st century tell us the exact same story about people, money, and, well, madness.
So let's just get right to it. This is the big question, right? The one that's been thrown around for more than a decade now. You've heard it from everybody. But is it a brilliant historical parallel? Or is it just, the laziest comparison in the book?
And man, people are divided on this. Just look at Reddit. You've got skeptics on one side saying it's a tired, lazy comparison for anything that goes up fast. But then on the other side, you have believers pointing out some pretty fundamental differences. This goes way deeper than just an internet argument. It really gets to the heart of what we decide has value.
So here's how we're going to tackle this. First, we'll dig into the debate itself. Then we're going to jump in a time machine to dissect that first ever bubble. After that, we'll explore the psychology that makes us all susceptible, see how it plays out today, and wrap it all up with the one lesson that history keeps trying to teach us.
Okay, first up, Bitcoin, a digital tulip? Let's get right into the oldest argument in crypto. Is Bitcoin really just a high-tech version of a 400-year-old flower craze?
This comparison isn't new at all. It's been around pretty much since Bitcoin started its crazy price climbs. So to really figure out if it holds any water, we have to go back. Way back. We need to understand what actually happened during the Dutch Golden Age.
All right, let's put on our investigator hats and perform a little historical autopsy here. We're going to deconstruct the world's very first bubble to see how it worked.
The first thing you notice is just how fast this all happened. The fever really takes off around 1634, and by 1636, prices are just astronomical. But here's the craziest part. The whole thing completely unraveled and collapsed in just a matter of months. Poof, gone.
Okay, get ready for this number. 4,200 guilders for one single tulip bulb. To put that into perspective, a skilled craftsman, someone doing pretty well for themselves, made about 300 guilders in an entire year. You were literally trading a house for a flower. It's just mind-boggling.
But here's where the popular story gets it a bit wrong. The myth is that this bubble completely wrecked the Dutch economy for years. The reality, according to modern historians, is that it was actually a much smaller affair. The frenzy was mostly contained to a specific group of merchants and traders. It didn't really have a major impact on the Dutch economy as a whole. So, yes, it was a bubble, but not the nationwide catastrophe it's often made out to be.
So if it wasn't just pure economics, what was it? Well, this brings us to the real engine that drives every single bubble: our own brains. It's all about human psychology. Why do we keep falling for this over and over and over again?
The answer is in a field called behavioral economics, and its core idea is pretty simple. We are not the perfectly logical robots we sometimes think we are, especially when money is involved. Our brains are hardwired with all these little glitches and emotional triggers that cause us to make some predictably irrational decisions.
And here they are, the usual suspects. You've got herd behavior. Everyone else is doing it, so it must be a good idea. Then there's good old FOMO, the fear of missing out. You see your neighbor getting rich and you just have to get in on it. Overconfidence is a big one too. You make a little money and suddenly you think you're a genius who can't possibly lose. And finally, loss aversion, which makes the crash so much more painful because this thing of losing money feels twice as bad as the joy of making it.
And if you think you're too smart to fall for any of this, just check out this quote. This is from Sir Isaac Newton. You know, the guy who discovered gravity? Yeah. He got completely wiped out in a massive bubble. It just goes to show you, even being one of the smartest people in history is no match for the madness of the crowd.
So, we have the history and we have the psychology. Let's bring it all into the 21st century. Are today's markets playing by the same old rules, or has technology completely changed the game?
Now, when you put them side by side, you see some massive differences. Tulip Mania was short, local, and once it crashed, it was over for good. Bitcoin, on the other hand, has been around for over a decade, it's global, and, this is the key, it has survived multiple huge crashes only to come back and hit new all-time highs. Plus, its foundation isn't a flower that can die, it's a global, decentralized network with a fixed supply. Those are some pretty important distinctions. But that psychological pattern we just talked about? Oh, it is alive and well. I mean, look no further than the meme stock frenzy. That was the same old human psychology, just supercharged with modern fuel, stimulus money, Reddit forums, and trading apps on your phone that make it all feel like a game.
And this chart shows you the rocket fuel for that fire. Look at that! Between 2020 and 2021, personal savings in the U.S. shot up by a staggering 147%. That's a massive amount of cash just sitting on the sidelines ready for a whole new generation of investors to deploy into the market.
We saw the exact same story play out with NFTs, an absolutely explosive boom, insane amounts of hype, followed by a devastating crash that wiped out more than 95% of the market. But what's happening now is really telling. In the aftermath, you're seeing this flight to quality, where the remaining interest is focused on projects with real historical significance or actual tangible utility. It's a classic sign of a market trying to find its footing after the mania burns out.
So, after looking at tulips, stocks, and digital art, what's the big takeaway here? What is the one lesson that history teaches us time and time again?
It's that nearly every single bubble follows this exact same 5-stage pattern. It's like a recipe. It starts with a spark, some exciting new innovation. Then comes a flood of capital, easy money that pours in and fuels the rise. Stage 3 is greed, where all caution gets thrown out the window and anyone who doubts the hype gets ridiculed. Then you hit the tipping point, confidence shatters, and it all ends in pure panic with everyone sprinting for the exits at once. The assets change, the decades change, but the cycle stays the same.
Which really leaves us with one final, crucial question to think about. If we know this pattern exists, if we can literally see the psychological traps that history has laid out for us, how do we draw the line for ourselves? What really separates a sound investment from just a speculative gamble? That's the question worth asking.